I'm something of a stock picker.
I'm something of a scientist myself.
That is, for a large portion of my stock portfolio, I'm actually picking stocks. It's actually the majority of my stock portfolio. This isn't to say that I don't have index funds within the portfolio. I do. They just tend to be held within my retirement accounts. So it's sort of my emergency sort of backup plan, I guess, if the stock picking venture doesn't go well. But I want to talk a bit more about that strategy of using passive index funds as your strategy to invest, rather than doing something like picking stocks, because really the data would suggest that picking stocks probably isn't a good idea. And seeing as though I am picking stocks, I want to see what I'm up against. Now, the first and probably most important factor when it comes to index funds, at least when we look at history, is their performance. That is, if you compare actively managed funds versus just using an index fund, the index fund will beat actively managed funds 80% of the time, at least when we look at the past decade, and that number has fluctuated still around that super majority or beyond that in favor of index funds. Now, I will say I do think that the way some of these comparisons are made are a little bit unfair in just saying that index funds are the best strategy of all time and can never be beaten, which again, there's a lot of merit there, but you're often comparing large cap mutual funds, actively managed funds, to something like an index fund. And a large cap fund is going to behave often very differently than, say, a very small fund or a concentrated portfolio. You're going to have very different results depending on the actual active strategy used. And in the case of an actively managed fund with tons of investors, those investors are going to have demands. So really, I think a lot of the underperformance probably comes from the fact that these funds have investors to please, and often there are hedging strategies involved. So even though they might not make as much as index funds in good years, maybe they'll make more in bad years. And there's so much variability here. Again, we're lumping in all actively managed funds. Some will outperform, some will underperform, though it is very hard to outperform for the long term, as the data would suggest. But to that often large group of people within a large fund that will demand that the fund sell when times are tough, or buy when things are euphoric, just because of general psychological pressures to do that sort of thing, that really goes to the fact that retail investors often vastly underperform even actively managed funds and index funds, at least when we look at the data. And again, you're going to get some people who outperform and many who will underperform. And the fact of the matter is the average person does not outperform the index, at least when we look at history. After all, there's the famous example that I've talked about on the channel before, and that's the fact that Peter Lynch, when he ran his fund, he ran an actively managed fund, and it happened to do really awesome. It had huge returns over a decade. And despite those huge returns, the average person who invested in that fund apparently lost money. Even when you had this great thing in front of you that dramatically outperformed the market, retail investors still found a way to mess it up. And that's because investing is hard. And by stock picking, you're inherently saying that you're above average, that you are going to be able to go against the curve when the going gets tough. And maybe you're going to be able to be disciplined when the going is good and you're able to sell high, buy low, sell high, all that great stuff, those great fundamentals that they teach you over at the TikTok School of Finance. But stock picking is inherently an arrogant position because you think you are better than the average. And there's not really a whole lot of data that you're going off to suggest that, because you need to collect 10, 20 years of data to really prove the point. And you have to take the leap of faith at some point, and that's where the arrogance kind of has to be if you're going to actually do stock picking for any period of time before you have that sort of historical data to suggest that you are a good stock picker. The point is, if history is a guide, and if you are the average person, which is more likely than not, this is myself included, that would imply that you are better off just taking an index, and you're probably not going to do as good if you're doing something like active stock picking. But of course, time will tell. Now, the next factor in favor of index funds is diversification. And this kind of goes without saying, because when you buy the index, you're effectively buying a share of everything. And when that happens, some interesting things kind of happen in that you are able to ride the coattails of the great stocks in the stock market, but you also have all those bad ones too that are not going to do well, that are going to go bankrupt and that are going to sort of pull those average returns down. But because you don't have to risk missing out on those great ones, because you're always going to get all of the best and all of the worst, and historically at least, the best have outweighed the worst, and you're getting positive returns over the long term. Whereas if you're individually picking stocks, and this really goes to a concentrated portfolio, maybe you have 5 or 10 holdings, there's a much higher likelihood that even all 10 of those holdings go belly up compared to buying 1,000 or 2,000 or however many holdings are in your average index fund. At least that covers a broad market. The chances of every single one of those companies failing or all of those stocks going down is much less likely, at least compared to a portfolio of, say, 5 to 10 stocks. Now, there's some debate on what the optimal level is that actually gets you all the benefits of diversification, where you don't really have to worry about, say, all of your holdings going belly up, where it just becomes so statistically unlikely. And that's something like maybe 15 to 20 holdings. So there's a lot of debate. It's not really an exact science. And of course, the future could always change. But with an index fund, it gets you instant diversification, at least if you buy something that has many holdings within it across many different industries. There are sort of specialized index funds that go towards very specific indices or very specific industries, and they're not really diversified. But if you compare that to, say, an S&P 500 index fund, that's going to cover your 500 or so biggest stocks in the US. And that's going to get you a lot of diversification there because that's 500 or so companies. That's a lot of places to sort of spread that risk around. Now, I will say, at least lately, there has been sort of a move towards the top in the S&P 500 at least, where the top few holdings are making up a huge share of the underlying index. So are you really as diversified as you think you are? But it's still going to be much more diversified than just having a few holdings that you pick yourself. And I suppose what this is getting at is that a portfolio that just has index funds has a much less likely chance of going all the way down to zero compared to a portfolio that has just a few holdings that aren't broadly diversified. It's just maybe 1, 2, 3, 4, 5, 6 companies, however many it is, but it's much less than something like an index fund, which covers all of the companies in a particular index. And another great thing about index funds is that they are generally very low cost, despite their benefits of having super broad diversification that gets you into thousands of holdings effectively. That would be very expensive to do if you're buying all the holdings yourself, or you'd have lots of transaction costs. With an index fund, you get the sort of economies of scale of having a pool of investors all investing into these tiny little slices of companies. And over the last few decades, expense ratios and fees for index funds have come all the way down to really where it's just a tiny, tiny fraction of whatever your portfolio balance is per year to hold a very broadly diversified index fund. And that's what's predominantly in my retirement accounts. It's these low-cost index funds offered by brokerages like Vanguard or Fidelity. Granted, this isn't too much of an advantage because when you don't invest with a fund, you're probably not going to have any fees to pay to a fund. You might still have transaction fees and all that stuff, but you're not paying an underlying expense ratio for someone else to manage that money for you, at least in many cases. Either way, definitely take a look at the fees that you're paying with whatever your stock holdings are. And index funds are really simple to get into. You don't need a ton of expertise. You can just go ahead and buy a share of the S&P 500 or whatever index it is that you're interested in, even the total world stock market, so you get even broader diversification and you're betting on sort of the whole world economy growing rather than just the US companies in the S&P 500. You don't need to be an expert in an underlying business. You're just buying the whole index and basically betting on the entire market to go up over the long term, at least if you are a long-term buy and holder. And that can help a lot with that return on invested brain damage metric that our friend Bill Ackman has said before. I've talked about it plenty of times on the channel at this point. But it's very easy to run an index fund portfolio. Again, you're not doing a bunch of research, you're just buying and sort of forgetting and letting the market do work. Although you still have to be emotionally ready to work through some pretty significant downswings, because even a broadly diversified index fund is going to have some hard times, at least when we look in the past. I mean, in the near past, we've had a pretty substantial dip. So if you're not ready to handle volatility, that's going to be a problem whether you're picking individual stocks or whether you're using index funds. But generally speaking, the sort of stress levels of picking individual stocks are going to be a lot higher than if you just bought an index, at least for someone like me. But like I said at the beginning of this video, I am still picking stocks despite these potential advantages of using something like an index fund. Granted, I am still using index funds. It's just in a more limited capacity as sort of my backup retirement plan if my active strategy doesn't work. If that were to happen, theoretically, I would still have this sort of backup plan in my tax advantaged accounts that are all in passive low-cost index funds, just letting the market ride, and that'll be sort of my long-term hedge against my own potential stupidity doing something like active investing. That's both in real estate, also in stocks, just trying to have that sort of backup plan. And I guess you could say I'm arrogant enough to give it a try. But anyways, like, comment, subscribe, all that great stuff. Definitely check out the affiliate links in the description below for some free stuff down there. But until next time, take care.